I'm Doris and I'm here to share with you about my stock account update. Today my stock account has earned $1,120 US. Two US stocks fell for a second straight day. So in my account today, including the post-market price, it rose for $1,074, which is a gain of 1.59%. So right now my account has $68,000 and I've made a total loss of $32,000. Today, SQQQ rose 42.62% to 35.58, and DRV rose 42% to 39.66. Both of the market bear ETFs rose for more than 2%. As for the market today, the market showed an overall decrease, in Dow Jones, the loss was 0.1%, and Nasdaq made a loss of 1%, and S&P 500 made a loss of 0.61%. Most of the industries today made a loss of more than 1%, with medical devices lost more than 2%, and the auto industry rose for 1.13% due to the rise of Tesla. U.S. stocks closed lower for a second straight day trading session on Monday. The two-day rise in Treasury yields strained market sentiment. The investors focused on U.S. stocks earnings and wait a big speech from the Fed Chairman Colin Powell tomorrow. Treasury yields continued to climb on Monday, with the benchmark 10-year yield up about 11 basis points to 3.64%. The yield on 2-year note rose 18 basis points to 4.483%. The ICE dollar index climbed 0.76%, further increased the downward pressure on U.S. stocks. George Cipollone, portfolio manager at Binjo Common Asset Management, said Treasury yields rose sharply for the second consecutive day, leaving the most stock market participants a bit shaken today. The two-year yield was incredible. I think that's the biggest factor in the decline. Profit-taking trading also sent U.S. stocks lower on Monday. Stocks had a hot start to the year, and some investors chose to settle down. Year-to-date, the S&P 500 has gained more than 7% and moved above 4,100 level last week, hitting a 5-month high, creating a bullish gold cross pattern. So far in the fourth quarter, the S&P 500 is up 15 and 16% from its October low, just one step away from the 20% gain threshold defined by many investors as the start of a bull market. The Nasdaq Composite Index has risen 5 straight weeks, the longest winning streak since November 2021. Gamma Investment Consultancy CEO Carl Chalupa said it expects corporate earnings to deteriorate further as economic growth slows later this year. He also noted that in the past 60 years, stocks have never recovered from the lows of the big bear market when they're not returned to fair value. He said, on average, when a stock is 25% undervalued, a new bull market starts. At current valuations, the S&P 500 needs to fall below 3,500 to reach fair value. If the S&P 500 is fall to 25% undervalued, it needs to be close to its low about 2,100 or 2,200 or 2191.86 during the outbreak. Halfway through the earnings session, the current trends would fall 2.7%. Markets are still watching for the Fed's monetary policy outlook. Federal Reserve Chairman Jerome Powell will address the Washington Economic Club on Tuesday. Until then, the market will be tight. Mr. Powell's comment on deflation led investors to actively enter the market last week, to push shares higher and ignore the prospect of the central bank raising interest rates again. Investors are starting to reassess the expectations of the Fed's monetary policy stance on the extraordinarily strong January report on Friday. And markets are expected to closely watch Powell's speech, especially his view on the labor market. Last week's stronger non-farm data and a strong rebound in the services sector PMI further added the concern that the Fed will stick raising interest rates. On Friday, the Federal Reserve data showed quarterly non-farm payrolls rose 517,000 in January, well above the market expectations of 185,000. The unemployment rate fell to 3.4%, the lowest level since May 1969. The January non-farm payrolls data showed that the U.S. labor market remains strong, despite the Fed's attempt to cool the economy, and the labor market is by raising interest rates. After the non-farm data, CME's Fed Watch tool showed that the market expects the Fed to raise interest rates by 25 basis points each in the next two meetings, with the end rate likely to fall in the 5% to 5.25% range, 25 basis points higher than previously expected. Analysts believe that the Fed's monetary policy decisions are very focused on labor market conditions, and the January non-farm payroll data undoubtedly strengthens the market's hawkish outlook for the bank. Thank you for listening. That's all I have today. Don't forget to subscribe and like. See you next episode.